I am live on Instagram. Hi. And I'm also live on YouTube. My name is May Duldalau. So on Instagram, my channel is called May Duldalau, and on YouTube, it's called Creative Abundance Now. And the blog is yesfinanciallyfree.com. Go there, get on the email list. You'll know when I'm live, what I will be talking about and what I'll be discussing. So yesfinanciallyfree.com is a great place. Get on the email list, get a free ebook, Working Parents Guide to Financial Freedom, as soon as you put your first name and email address on the right side. So I highly recommend you go there and get on that email list. There's also great blogs there. I want to tell you about myself. So my story, I used to be really bad with money. In 2011, I had over $41,000 of debt. That was like credit cards and personal lines of credit. It wasn't a house, wasn't a mortgage, it wasn't a business. It was just pure overspending. Okay, so consumer debt. And by 2016 April, all the debt was paid off. In December, I quit my job. I was working at a bank. I was a banking assistant. So I quit that and became a full-time mother. I was already a part-time blogger, right? And I continued, but I started doing Finance Freedom Masterminds, which is a group. I created groups of people where I brought together, and all we did was work to make each other financially free as quickly as possible. Finance Freedom Mastermind is a one-year program, which I still do. You can always join it. You can go to yesfinanciallyfree.com products. Now, it is limited because I only take 10 people in my mastermind. So you may or may not get in. But right now, it is open. So you can go there, check it out at yesfinanciallyfree.com/products. And let's see, more of my story. In 2017, I took my son out of school, went on 1 month of vacation. We went to, I live in Honolulu, Hawaii, by the way. I live in Waikiki. So I went surfing yesterday, and the day before yesterday, it was so much fun. The beach is just 2 blocks down the road, like super close. And I have a nice view of Diamond Head right there, LOI Canal. I live in a really nice place. And so we bought our first condo in Waikiki in 2017 and our second condo in Waikiki in 2018. We sold one in 2019 to our manager. We had an Airbnb business, and he was actually a mastermind member. So we sold him his very first property. That was his goal. We used the money to buy this condo, which is twice as big, and we live in it. It's a 2-bedroom, really nice condo in Waikiki. And so we own 2 right now, 2 condos. One is an Airbnb business, one which we live in. We also have, we went on a month of vacation in 2017, Niagara Falls. I went on a cruise to Mexico, which I had been visualizing and dreaming of. Finally went on a cruise. Never been to Mexico, never been on a cruise, right? Visited my sister in Washington, D.C., went to LA, went to Toronto. So we had a really good time. And now I am here sharing with you information on investing. So today's topic is Postscripts and Appendixes of The Intelligent Investor by Benjamin Graham. The Superinvestors of Graham-and-Doddsville by Warren E. Buffett. So we're going to learn from Warren Buffett's words today. We have been reading this book. Now, if you've been following me, I've been reading this book for the last month, Benjamin Graham, Intelligent Investor. And the reason I'm reading it is because the market has been down. The economy has gone down. And they say that the best thing you can do is be careful with what stocks you invest in. And to get those kinds of skills, you need to study. And this is a book recommended by Warren Buffett, who is one of the most successful investors of all time. So I'm reading it, and I'm almost done. Today we're finishing the book, so it's pretty exciting. It's been a long book. Now, it's still going to take me time to digest it a little, but I did read this whole book, and all the recordings are on my blog, yesfinanciallyfree.com. The latest blog post has all the recordings in one place, just so you can check it out there. I'm going to put summaries of the chapters as I go along too. So that's why I'm reading this book. Learn from rich people, right? What to do. I shared my personal story with you just to let you know that if you suck with money, if you're bad with money, if you have a regular job, you're not famous, you're not rich, you can change your life. I changed my lifestyle, I went from working a full-time job, being exhausted mother, to quitting that job and having time for myself and being a mother and being a wife and just having a better life while also improving the wealth of my family. Okay, so we live in a much nicer place, than we used to. We own real estate instead of rent. We have assets that are growing. Our net worth improved by $500,000 by 2016. We were making almost $500 a month of passive income by then. So if you have a lot of debt, you can focus on passive income and net worth and wealth instead of your debt and create financial freedom. So let's do it. Okay, so I'm going to start reading. Let's begin. Okay, and if anytime you want to contact me, go to my blog, yesfinanciallyfree.com, get on the email list and reply to any of my emails and I will respond to you. Okay, all right. Postscript. We know very well two partners who spent a good part of their lives handling their own and other people's funds in Wall Street. Some hard experience taught them it was better to be safe and careful rather than to try to make all the money in the world. They established a rather unique approach to security operations, which combined good profit possibilities with sound values. They avoided anything that appeared overpriced and were rather too quick to dispose of issues that had advanced to levels they deemed no longer attractive. Their portfolio was always well diversified, with more than 100 different issues represented. In this way, they did quite well through many years of ups and downs in the general market. They averaged about 20% per annum on the several millions of capital they had accepted for management, and their clients were well pleased with the results. That's amazing. In the year in which the first edition of this book appeared, an opportunity was offered to the Partners Fund to purchase a half interest in a growing enterprise. For some reason, the industry did not have Wall Street appeal at the time, and the deal had been turned down by quite a few important houses. But the pair was impressed by the company's possibilities. What was decisive for them was that the price was moderate in relation to current earnings and asset value. The partners went ahead with the acquisition, amounting in dollars to about 1/5 of their fund. They became closely identified with the business interest, which prospered. In fact, it did so well that the price of its shares advanced to 200 times or more the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start, the quotation appeared much too high in terms of the partners' own investment standards. But since they regarded the company as a sort of family business, they continued to maintain a substantial ownership of the shares despite the spectacular price rise. A large number of participants in the fund did the same, and they became millionaires through their holding in this one enterprise, plus later organized affiliates. Ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations in the partners' specialized fields, involving much investigation, endless pondering, and countless individual decisions. Are there morals to this story of value to the intelligent investor? An obvious one is that there are several different ways to make and keep money in Wall Street. Another not so obvious is that one lucky break or one supremely shrewd decision we tell them apart, may count for more than a lifetime of journeyman's efforts. But behind the luck or the crucial decision, there must usually exist a background of preparation and discipline capacity. One needs to be sufficiently established and recognized so that these opportunities will knock at his particular door. One must have the means, the judgment, and the courage to take advantage of them. Of course, we cannot promise a like spectacular experience to all intelligent investors who remain both prudent and alert through the years. We are not going to end with J.J. Raskopp's slogan that we made fun of at the beginning, everybody can be rich, but interesting possibilities abound in the financial scene, and the intelligent and enterprising investor should be able to find both enjoyment and profit in this three-ring circus. Excitement is guaranteed. Number 1, veracity requires the admission that the deal almost fell through because the partners wanted assurance that the purchase price would be 100% covered by asset value. a future 300 million or more in market gain turned on, say, $50,000 of accounting items. By dumb luck, they got what they insisted on. Okay, so that is the postscript. Now we're doing the appendixes. And this is number 1, The Superinvestors of Graham-and-Doddsville, written by Warren E. Buffett. So we're going to read Warren Buffett now. Editor's note, this article is an edited transcript of a talk given at Columbia University in 1984 commemorating the 50th anniversary of security analysis, written by Benjamin Graham and David L. Dodd. That's the next book I'm going to read. This specialized volume first introduced the ideas later popularized in The Intelligent Investor. Buffett's essay offers a fascinating study of how Graham's disciples have used Graham's value investing approach to realize phenomenal success in the stock market. Is the Graham and Dodd look for values with a significant margin of safety relative to prices approach to security analysis out of date? Many of the professors who write textbooks today say yes. They argue that the stock market is efficient. That is, that stock prices reflect everything that is known about a company's prospects and about the state of the economy. There are no undervalued stocks, these theorists argue, because there are smart security analysts who utilize all available information to ensure unfailingly appropriate prices. Investors who seem to beat the market year after year are just lucky. If prices fully reflect available information, this sort of investment adeptness is ruled out, writes one of today's textbook authors. Well, maybe, but I want to present to you a group of investors who have year in and year out beaten the Standard & Poor's 500 stock index. The hypothesis that they do this by pure chance is at least worth examining. Crucial to this examination. Hi, John. How's it going? Are you still in the Philippines? Are you here in Hawaii? What are you up to? Nice to see you on the live. How have you been? Good to catch up. Where are you? Where are you at? Are you here in Hawaii? What are you doing? Waiting for John to let me know. I'm reading. Hey, I'm back here. You're here back in Hawaii. Awesome. That is cool. Nice. So yeah, we went surfing yesterday and the day before. It was so fun. Nice to have you on. I go on live every weekday at 8:30 a.m. and I read financial books. So today I'm reading Benjamin Graham, The Intelligent Investor. And this is the book recommended by Warren Buffett. Yeah, so I'm reading a talk by Warren Buffett about value investing that he gave at Columbia in 1984. So I've never read it either, so I'm just reading it. I just finished this whole book. Took me a month. I've been reading 1 chapter or 2 chapters every day. Every weekday. Oh, and John, I have a blog. Yes, financiallyfree.com. It is in my profile. That is where all the recordings are. And I'm writing a summary of the book. But I got all the cool stuff. So get on my email list. Go on the right side, put in your first name, your email, get on the email list. Then you'll know what I do these lives on. So how you been? It's so cool to have you on. Are you still doing your energy? You were doing a plan for energy in the Philippines, cell phone service, something like that, right? Are you still doing that? Are you still doing that cool stuff? Gosh, I remember when we ran into you at Starbucks. That was so funny. So random too. How are you doing? So cool. When you run into people when you're on live and you haven't talked to them in a while, you're like all excited. Every time I get someone pop in every time, it's like, oh, I haven't talked to you so long. So it's really neat. You should get on the email list though. Email me or contact me and you can talk or something. Catch up. See what you're doing. Yeah. Okay. Well, I'll let you write your response, and I'm going to finish reading Warren Buffett, a very smart guy. So I will. Okay, cool. Okay. So basically, Warren Buffett just said a lot of people say the stock market is inefficient and this whole method of investing is out of date. So then he says, well, maybe. But he wants to present to you a group of investors who have year in and year out beaten the Standard & Poor's 500 stock index. The hypothesis that they do this by pure chance is at least worth examining. Crucial to this examination is the fact that these winners were all well known to me and pre-identified as superior investors, the most recent identification occurring over 15 years ago. Absent this condition, that is, if I had just recently searched among thousands of records to select a few names for you this morning, I would advise you to stop reading right here. I should add that all these records have been audited, and I should further add that I have known my company is still being run by my staff, though the crisis had it halted, like here. I see. Cool. Okay. If I had recently, I would advise you to stop reading right here. I should add that all these records have been audited, and I should further add that I have known many of those who have invested with these managers, and the checks received by those participants over the years have matched the stated records. Before we begin this examination, I would like you to imagine a national coin flipping contest. Let's assume we get 225 million Americans up tomorrow morning, and we ask them all to wager $1. They go out in the morning at sunrise, and they all call the flip of a coin. If they call correctly, they win $1 from those who called wrong. Each day, the losers drop out, and the subsequent day, the stakes build as well as all previous winners are put on the line. After 10 flips on 10 mornings, there will be approximately 220,000 people in the United States who have correctly flipped 10 flips in a row. They each will have won a little over $1,000. Interesting. Now, this group will probably start getting a little puffed up about this, human nature being what it is. They may try to be modest, but at cocktail parties, they will occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of flipping. Assuming that the winners are getting the appropriate rewards from the losers, in another 10 days, we will have 215 people who have successfully called their coin flips 20 times in a row, and who, by this exercise, each have turned $1 into a little over $1 million. 225 million would have been lost. 225 million would have been won. By then, this group will really lose their heads. They will probably write books on how I turned $1 into $1 million in 20 days, working 30 seconds a morning. Worse yet, they'll probably start jetting around the country, attending seminars on efficient coin flipping and tackling skeptical professors with, if it can't be done, why are there 215 of us? But then business school professor will probably be rude enough to bring up the fact that if 225 million orangutans had engaged in a similar exercise, the results would be much the same. 215 egotistical orangutans with 20 straight winning flips. I would argue, however, that there are some important differences in the examples I am going to present. For one thing, if A, you had taken 225 million orangutans distributed roughly as the US population is, if B, 215 winners were left after 20 days, and if C, you found that 40 came from a particular zoo in Omaha, you would be pretty sure you were on to something. So you would probably go out and ask the zookeeper about what he's feeding them, whether they had special exercises, what books they read, and who knows what else. That is, if you found any really extraordinary concentrations of success, you might want to see if you could identify concentrations of unusual characteristics that might be causal factors. Scientific inquiry naturally follows such a pattern. If you were trying to analyze possible cases of a rare type of cancer with, say, 1,500 cases a year in the United States, and you found that 400 of them occurred in some small mining town in Montana, you would get very interested in the water there or the occupation of those afflicted. Hi, Work do Toledo. Welcome. Let me know where you're from. Thanks for being on the live. We have John here from Hawaii on as well. I'm reading a speech from Warren Buffett. I submit to you that there are ways of defining an origin other than geography. In addition to geographical origins, there can be what I call an intellectual origin. I think you will find that a disproportionate number of successful coin flippers in the investment world came from a very small intellectual village that could be called Graham-and-Doddsville. A concentration of winners that simply cannot be explained by chance can be traced to this particular intellectual village. Conditions could exist that would make even that concentration unimportant. Perhaps 100 people were simply imitating the coin flipping call of some terribly persuasive personality. When he called heads, 100 followers automatically called the coin the same way. When he called, if the leader was part of the 215 left at the end, the fact that 100 came from the same intellectual origin would mean nothing. You would simply be identifying one case as 100 cases. Similarly, let's assume that you lived in a strongly patriarchal society and every family in the United States conveniently consisted of 10 members. Further assume that the patriarchal culture was so strong that when the 225 million people went out the first day, every member of the family identified with the father's call. Now, at the end of the 20-day period, you would have 215 winners, and you would find that they came from only 21.5 families. Some naive types might say that this indicates an enormous hereditary factor as an explanation of successful coin flipping. But of course, it would have no significance at all because it would simply mean that you didn't have 215 individual winners, but rather 21.5 randomly distributed families who were winners. In this group of successful investors that I want to consider, there has been a common intellectual patriarch, Ben Graham. But the children who left the house of this intellectual patriarch have called their flips in very different ways. They have gone to different places and bought and sold different stock and different companies. Yet they have had a combined record that simply cannot be explained by random chance. It certainly cannot be explained by the fact that they are all calling flips identically because a leader is signaling the calls to make. The patriarch has merely set forth the intellectual theory for making coin calling decisions, but each student has decided on his own manner of applying the theory. The common intellectual theme of the investors from Graham-and-Doddsville is this: they search for discrepancies between the value of a business and the price of small pieces of that business in the market. Essentially, they exploit those discrepancies without the efficient markets theorists' concern as to whether the stocks are bought on Monday or Thursday or whether it is January, July, etc. Incidentally, when businessmen buy businesses, which is just what our Graham and Dodd investors are doing through the medium of marketable stocks, I doubt that many are cranking into their purchase decision the day of the week or the month in which the transaction is going to occur. If it doesn't make any difference whether all of a business is being bought on a Monday or a Friday, I am baffled why academicians invest extensive time and effort to see whether it makes a difference when buying small pieces of those same businesses. Our Graham and Dodd investors, needless to say, do not discuss beta, the capital asset pricing model, or covariance in return among securities. These are not subjects of any interest to them. In fact, most of them would have difficulty defining those terms. The investors simply focus on two variables: price and value. I always find it extraordinary that so many studies are made of price and volume behavior, the stuff of chartists. Can you imagine buying an entire business simply because the price of the business had been marked up substantially last week and the week before? Or of course, the reason a lot of studies are made of these price and volume variables is that now, in the age of computers, there are almost endless data available about them. It isn't necessarily because such studies have any utility. It's simply that the data are there and academicians have worked hard to learn the mathematical skills needed to manipulate them. Once these skills are acquired, it seems sinful not to use them, even if the usage has no utility or negative utility. As a friend said to a man with a hammer, everything looks like a nail. I think the group that we have identified by a common intellectual home is worthy of study. Incidentally, despite all the academic studies of the influence of such variables as price, volume, seasonability, capitalization, size, etc., upon stock performance, no interest has been evidenced in studying the methods of this unusual concentration of value-oriented winners. I begin this study of results by going back to a group of 4 of us who worked at Graham-Newman Corporation from 1954 through 1956. There were only 4. I have not selected these names from among thousands. I offered to go to work at Graham-Newman for nothing after I took Ben Graham's class, but he turned me down as overvalued. He took this value stuff very seriously. After much pestering, he finally hired me. There were 3 partners and 4 of us at the peasant level. All 4 left between 1955 and 1957 when the firm was wound up, and it's possible to trace the record of the 3. The first example, see Table 1, pages 302 to 303, is that of Warren Schloss, S-C-H-L-O-S-S, I guess. Walter Schloss. Walter never went to college, but took a course from Ben Graham at night at the New York Institute of Finance. Walter left Graham-Newman in 1955 and achieved the record shown here over 28 years. Here is what Adam Smith, after I told him about Walter, wrote about him in Supermoney in 1972. He has no connections or access to useful information. Practically no one in Wall Street knows him, and he is not fed any ideas. He looks up the numbers in the manuals and sends for annual reports, and that's about it. In introducing me to Schloss, Warren had also, to my mind, described himself. He never forgets that he is handling other people's money, and this reinforces his normal strong aversion to loss. He has total integrity and a realistic picture of himself. Money is real to him and stocks are real. From this flows an attraction to the margin of safety principle. Walter has diversified enormously, owning well over 100 stocks currently. He knows how to identify securities that sell at considerably less than their value to a private owner. And that's all he does. He doesn't worry about whether it's January. He doesn't worry about whether it's Monday. He doesn't worry about whether it's an election year. He simply says, if a business is worth $1, I can buy it for 40 cents. Something good may happen to me. And he does it over and over and over again. He owns many more stocks than I do and is far less interested in the underlying nature of the business. I don't seem to have very much influence on Walter. That's one of his strengths. No one has much influence on him. The second case is Tom Knapp, Tomknaap, who also worked at Graham-Newman with me. Tom was a chemistry major at Princeton before the war. When he came back from the war, he was a beach bum. And then one day he read that Dave Dodd was giving a night course in investments at Columbia. Tom took it on a non-credit basis. He got so interested in the subject from taking that course that he came up and enrolled at Columbia Business School, where he got the MBA degree. He took Dodd's course again and took Ben Graham's course. Incidentally, 35 years later, I called Tom to ascertain some of the facts involved here, and I found him on the beach again. The only difference is that now he owns the beach. In 1968, Tom Knapp and Ed Anderson, also a Graham disciple, along with 1 or 2 other fellows of similar persuasion, formed Tweedlee, Brown and Partners. Tweedlee, Brown, Partners, and their investment results appear in Table 2. Tweedlee Brown built that record with very wide diversification. They occasionally bought controlled businesses, but the record of the passive investments is equal to the record of the control investments. Table 3 describes the third member of the group who formed Buffett Partnership in 1957. The best thing he did was to quit in 1969. Since then, in a sense, Berkshire Hathaway has been a continuation of the partnership in some respects. There is no single index I can give you that I would feel would be a fair test of investment management at Berkshire, but I think that any way you figure it, it has been satisfactory. Table 4 shows the record of the Sequoia Fund. Sequoia Fund! That's the one in The Big Short. There's a movie, The Big Short, and it has the Sequoia Fund. Ha! Which is managed by a man whom I met in 1959 in Ben Graham's class, Bill Ruan. After getting out of Harvard Business School, he went to Wall Street. Then he realized that he needed to get a real business education, so he came up to Ben's course at Columbia, where we met in early 1951. Bill's record from 1951 to 1970, working with relatively small sums, was far better than average. When I wound up Buffett partnership, I asked Bill if he would set up a fund to handle all our partners. So he set up the Sequoia Fund. He set it up at a terrible time, just when I was quitting. He went right into the two-tier market and all the difficulties that made for performance comparative performance for value-oriented investors. I'm happy to say that my partners, to an amazing degree, not only stayed with him but added money, and the happy results shown. There's no hindsight involved here. Bill was the only person I recommended to my partners, and I said at the time that if he achieved a 4-point per annum advantage over the Standard & Poor's, that would be solid performance. Bill has achieved well over that, working with progressively larger sums of money. That makes things much more difficult. Size is the anchor of performance. There is no question about it. It doesn't mean you can't do better than average when you get larger, but the margin shrinks. And if you ever get so you're managing $2 trillion and that happens to be the amount of the total equity evaluation in the economy, don't think that you'll do better than average. I should add that in the records we've looked at so far, throughout this whole period, there was practically no duplication in these portfolios. These are men who select securities based on discrepancies between price and value, but they make their selections very differently. Walter's largest holdings have been such stalwarts as Hudson Pulp and Paper and Jetto Highland Coal and New York Trap Rock Company, and all those other names that come instantly to mind to even a casual reader of the business pages. Tweedy Brown's selections have sunk even well below that level in terms of name recognition. On the other hand, Bill has worked with big companies. The overlap among these portfolios has been very, very low. These records do not reflect one guy calling the flip and 50 people yelling out the same thing after him. Table 5 is the record of a friend of mine who is a Harvard law graduate who set up a major law firm. I ran into him in about 1960 and told him that law was fine as a hobby, but he could do better. He set up a partnership quite the opposite of Walter's. His portfolio was concentrated in a very few securities, and therefore his record was much more volatile, but it was based on the same discount from value approach. He was willing to accept greater peaks and valleys of performance, and he happens to be a fellow whose whole psyche goes toward concentration, with the results shown. Incidentally, this record belongs to Charlie Munger, my partner for a long time in the operation of Berkshire Hathaway. When he ran his partnership, however, his portfolio holdings were almost completely different from mine and the other fellows mentioned earlier. Table 6 is the record of a fellow who was a pal of Charlie Munger's, another non-business school type who was a math major at USC. He went to work for IBM after graduation and was an IBM salesman for a while. After I got to Charlie, Charlie got to him. This happens to be the record of Rick Yeren, Guerin. Rick, from 1965 to 1983, against a compounded gain of 316% for the S&P, came off with 22,200%. Which, probably because he lacks a business school education, he regards as statistically significant. One sidelight here, it is extraordinary to me that the idea of buying dollar bills for 40 cents takes immediately with people, or it doesn't take at all. It is like an inoculation. If it doesn't grab a person right away, I find that you can talk to him for years and show him records, and it doesn't make any difference. They just don't seem able to grasp the concept, simple as it is. A fellow like Rick Yeren, who had no formal education in business, understands immediately the value approach to investing, and he's applying it 5 minutes later. I've never seen anyone who became a gradual convert over a 10-year period to this approach. It doesn't seem to be a matter of IQ or academic training. It's instant recognition, or it is nothing. Table 7 is the record of Stan Perlmutter. Perlmutter? Perlmeter. Stan was a liberal arts major at the University of Michigan who was a partner in the advertising agency of Boswell and Jacobs. We happened to be in the same building in Omaha. In 1965, he figured out I had a better business than he did, so he left advertising. Again, it took 5 minutes for Stan to embrace the value approach. Perlmutter does not own what Walter Schloss owns. He does not own what Bill Ruin owns. These are records made independently, but every time Perlmutter buys a stock, it's because he's getting more for his money than he's paying. That's the only thing he's thinking about. He's not looking at quarterly earnings projections. He's not looking at next year's earnings. He's not thinking about what day of the week it is. He doesn't care what investment research from any place says. He's not interested in price momentum, volume, or anything. He's simply asking, what is the business worth? Table 8 and Table 9 are the records of 2 pension funds I've been involved in. They are not selected from dozens of value-oriented managers. Very, very few pension funds are managed from a value standpoint. Table 8 is the Washington Post Company's pension fund. It was with a large bank some years ago, and I suggest that they would do well to select managers who had a value orientation. As you can see, overall, they have been in the top percentile ever since they made the change. The Post told the managers to keep at least 25% of these funds in bonds, which would not have been necessarily the choice of these managers. So I've included the bond performance simply to illustrate that this group has no particular expertise about bonds. They wouldn't have said they did. Even with this drag of 25% of their fund in an area that was not their game, they were in the top percentile of fund management. The Washington Post experience does not cover a terribly long period, but it does represent many investment decisions by 3 managers who were not identified retroactively. Table 9 is the record of the FMC Corporation Fund. I don't manage a dime of it myself, but I did in 1974 influence their decision to select value-oriented managers. Prior to that time, they had selected managers much the same as most larger companies. They now rank number 1 in the Becker survey of pension funds for their size over the period of time subsequent to this conversion to the value approach. Last year, they had 8 equity managers of any duration beyond a year. 7 of them had a cumulative record better than the S&P. All 8 had a better record last year than the S&P. The net difference now between a median performance and the actual performance of the FMC fund over this period is $243 million. FMC attributes this to the mindset given to them about the selection of managers. Those managers are not the managers I would necessarily select, but they have the common denominator of selecting securities based on value. So, these are 9 records of coin flippers from Graham-and-Doddsville. I haven't selected them with hindsight from among thousands. It's not like I'm reciting to you the names of a bunch of lottery winners. People I had never heard of before they won the lottery. I selected these men years ago based upon their framework for investment decision making. I knew what they had been taught, and additionally, I had some personal knowledge of their intellect, character, and temperament. It's very important to understand that this group has assumed far less risk than average. Note their record in years when the general market was weak. While they differ greatly in style, these investors are mentally always buying the business and not buying the stock. A few of them sometimes buy whole businesses. Far more often, they simply buy small pieces of businesses. Their attitude, whether buying all or a tiny piece of a business, is the same. Some of them hold portfolios with dozens of stocks, others concentrate on a handful, but all exploit the difference between the market price of a business and its intrinsic value. I'm convinced that there is much inefficiency in the market. These Graham-and-Doddsville investors have successfully exploited gaps between price and value. When the price of a stock can be influenced by a herd on Wall Street, with prices set at the margin by the most emotional person, or the greediest person, or the most depressed person, it is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical. I would like to say one important thing about risk and reward. Sometimes risk and reward are correlated in a positive fashion. If someone were to say to me, I have here a 6-shooter and I've slipped one cartridge into it, why don't you just spin it and pull it once? If you survive, I will give you $1 million. I would decline, perhaps stating that $1 million is not enough. Then he might offer me $5 million to pull the trigger twice. Now that would be a positive correlation between risk and reward. The exact opposite is true with value investing. If you buy a dollar bill for 60 cents, it's riskier than if you buy a dollar bill for 40 cents. But the expectation of reward is greater in the latter case. The greater the potential for reward in the value portfolio, the less risk there is. One quick example. The Washington Post Company in 1973 was selling for $80 million in the market. At the time, that day, you could have sold the assets to any one of 10 buyers for not less than $400 million, probably appreciably more. The company owned the Post, Newsweek, plus several television stations in major markets. Those same properties are worth $2 billion now. So the person who would have paid $400 million would not have been crazy. Now, if the stock had declined even further to a price that made the valuation $40 million instead of $80 million, its beta would have been greater, and to people who think beta measures risk, the cheaper price would have made it look riskier. This is truly Alice in Wonderland. I have never been able to figure out why it's riskier to buy $400 million worth of properties for $40 million than $80 million. And as a matter of fact, if you buy a group of such securities and you know anything at all about business valuation, there's essentially no risk in buying $400 million for $80 million. $400 million for $80 million. Particularly if you do it by buying 10 $40 million piles for $8 million each. Since you don't have your hands on the $400 million, you want to be sure you are in with honest and reasonably competent people. But that's not a difficult job. You also have to have the knowledge to enable you to make a very general estimate about the value of the underlying businesses, but you do not cut it close. That is what Ben Graham meant by having a margin of safety. You don't try and buy businesses worth $83 million for $80 million. You leave yourself an enormous margin. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that same principle works in investing. In conclusion, some of the more commercially minded among you may wonder why I'm writing this article. Adding many converts to the value approach will perforce narrow the spreads between price and value. I can only tell you that the secret has been out for 50 years, ever since Ben Graham and Dave Dodd wrote Security Analysis. Yet I have seen no trend toward value investing in the 35 years that I've practiced it. There seems to be some perverse human characteristic that likes to make easy things difficult. The academic world, if anything, has actually backed away from the teaching of value investing over the last 30 years. It's likely to continue that way. Ships will sail around the world, but the flat earth society will flourish. There will continue to be wide discrepancies between price and value. Hi, Balloon Creations. How are you? Where are you from? I was just reading from Warren Buffett in the book by Ben Graham. Ships will sail around the world, but the flat earth society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. Tables 1 through 9 follow. Okay, so table 1, he has Walter J. Schloss. There is table 1 for YouTube. Table 1 for Instagram. Check it out. Okay. So he shows how Walter Schloss did. Okay, and he does it per year. He has the S&P overall gain, including dividends. He has the Wall Street Journal, WJS Limited Partners. Oh, Walter J. Schloss Limited Partners overall gain for that year. And the partnership overall gain. So I guess he has partners in partnership. Excuse me. And then he has some side notes on the side. But basically, in 1956, the S&P did 7.5%, whereas WJS did 5.1 and WJS partnership 6.8. Standard & Poor's 28.25 year compounded gain was 887.2%. So Standard & Poor's beat them in 1956, okay? In 1957, the Standard & Poor lost 10.5%. And WJS only lost 4.7% on both things. 1958, S&P went up 42.1%. WJS Limited Partners went up 42.1%, and WJS Partnership went up 54.6%. WJS Limited Partners' 28.25 year compounded gain was 6,678.8%. 1959, S&P overall gain was 12.7, WJS was 17.5, and the partnership was 23.3. In 1960, the S&P was negative 1.6, whereas WJS was a 7% gain, and WJS partnership was 9.3%. The WJS partnership 28.25 year compounded gain was 23,104.7%. Holy cow, right? 1961, the S&P did 26.4% gain, WJS did 21.6, and WJS partnership did 28.8. 1962, the S&P lost 10.2%. WJS went up 8.3, and partnership went up 11.1. Standard & Poor's 28.25 year annual compounded rate was 8.4%. In 1963, the S&P was at 23.3% gain. WJS was 15.1, and WJS partnership was 20.1. In 1964, 16.5 for S&P, 17.1 for WJS, 22.8 for partnership. And the WJS Limited Partners 28.25 year annual compounded rate was 16.1%. In 1965, we have 13.1 for the S&P, 26.8 for partners, and 37.5 for partnership. 1966, the S&P lost 10.4, whereas WJS gained 0.5, partnership 0.7. WJ's partnership 28.25 annual compounded return was 21.3%. In 1967, the S&P gain was 26.8, WJS was 25.8, partnership 34.4. 1968, S&P was 10.6, WJS was 26.6, WJS partnership was 35.5. During the history of the partnership, it has owned over 800 issues and at most times has had at least 100 positions. Present assets under management approximate $45 million. The difference between returns of the partnership and returns of limited partners is due to allocations to the general partner for management. In 1969, the S&P lost 7.5. Both the other WJS lost 9.9. 1970, S&P gained 2.4. Partners lost 8.2, 8.2. 1971, S&P gained 14.9. Partners gained 25.5. Partnership 28.3. 1972, S&P gained 19.8. Partners 11.6. Partnership 15.5. In 1973, the S&P declined 14.8. Partners declined 8 and 8. 1974 had a negative 26.6% decline, whereas partnership negative 6.2. In 1965, there was a 36.9% gain in the S&P. For WJS, it was 42.7% gain, and for partnership, it was 52.2% gain. 1976, 22.4% gain S&P, 29.4% gain partners, and 39.2% partnership. 1977 had a loss for the S&P of 8.6, while the gain was 25.8 for WJ's partners and 34.4% for partnership. 1978, the gain was 7% for S&P, but 36.6% for partners and 48.8% for partnership. 1979, 17.6% was overall gain for S&P, 29.8% for partners, and 39.7% for partnership. In 1980, 32.1% gain for S&P, 23.3% gain for partners, 31.1% gain for partnership. 1984, 6.7% gain for S&P, 18.4% for partners, 24.5% for partnership. In 1982, 20.2% gain for S&P, 24.41% gain for partners, 32.1% gain for partnership. 1983 is 22.8% gain for S&P, 38.4% gain for partners, and 51.2% gain for partnership. And the first quarter of 1984, they threw it in there, 2.3% gain for S&P, 0.8% gain for WJ's partners, and WJ's partnership was 1.1%. So overall, the fund did far better than the S&P, both of the funds. Basically, they had less losses, really, and the gains oftentimes were much bigger. Although sometimes S&P beat them, but in general, the losses were far less and the gains far greater when sometimes. So Schloss did much better. And then table 2 is Tweedy Brown. And table 3 is Warren Buffett. So there you have the two tables. Tweedy Brown here, Warren Buffett over there. Okay. So Tweedy Brown, it's a much shorter table. He compares Tweedy Brown with Dow Jones and S&P, Tweedy Brown overall, and Tweedy Brown limited partners. So he has two different funds, I guess. So 1968, the 9 months of 1968, I don't know why 9 months. I guess he started in 1968. Excuse me. Dow Jones was 6% gain. S&P was 8.8. Tweedy Brown was 27.6. And Tweedy Brown limited partners was 22. That's a big difference. In 1969, the Dow Jones had negative 9.5. The S&P was negative 6.2. Tweedy Brown was 12.7. Tweedy Brown limited partners was 10. So they had gain. Dow Jones and S&P had losses, whereas Tweedy Brown and they both had very substantial gains. 1970, there was negative 2.5 for Dow, negative 6.1 for S&P, negative 1.3 for Tweedy Brown, negative 1.9 for the limited partners. 1971, 20.7% gain for Dow Jones, 20.4% gain for S&P, 20.9% for Tweedy Brown, 16.1% for limited partners gain. 1972 is 11% gain for Dow Jones, 15.5% for S&P. Tweedy Brown was 14.6% gain. Partners was 11.8% gain. 1973 is a 2.9% gain for Dow Jones, 1% gain for S&P. Tweedy Brown's was an 8.3% gain, and the partners was 7.5%. Ooh, here's a kicker. Dow Jones in 1974 had a negative 31.8%. S&P was negative 38.1, but Tweedy Brown was 1.5% positive. Tweedy Brown limited partners 1.5% positive. That's awesome. 1975, Dow Jones was 36.9% gain. S&P was 37.8% gain. Tweedy Brown was 28.8% gain. Limited partners 22% gain. 1976, Dow Jones had a 29.6% gain. S&P had a 30.1% gain. Tweedy Brown had a 40.2% gain. Partners had 32.8% gain. In 1977, Dow Jones had a negative 9.9% gain loss. S&P had a 4% loss. But Tweedy had a 23.4% gain. Holy cow. And limited partners had 18.7% gain. 1978, Dow Jones had an 8.3% gain. S&P had 11.9% gain, but Tweedy Brown had a 41% gain. Partners had a 32% gain. 1979, Dow Jones had a 7.9% gain. S&P had a 12.7% gain, but Tweedy Brown had a 25.5% gain, 20.5% gain for limited partners. 1980, 13% gain Dow Jones, 21% gain S&P, 21.4% gain Tweedy Brown, 17.3% gain, limited partners. 1981 had a negative 3.3% loss for Dow Jones, 2.7% gain for S&P. Tweedy Brown was 14.4% gain, 11.6% gain for limited partners. In 1982, Dow Jones had a gain of 12.5%, S&P was 10.1%, Tweedy Brown was 10.2%, limited partners 8.2%. 1983, 44.5% gain for the Dow, 44.3% gain for S&P. Tweedy Brown had 35% gain, limited partners 28.2. Total year is 15 and 3/4 years. The total year growth of the Dow Jones was 191.8%. For the S&P was 238.5%. For Tweedy Brown, it was 1,661.2%. For limited partners, it was 936.4%. The Standard & Poor's 15 and 3/4 year annual compounded rate was 7%. The limited partners annual compounded rate was 16%, and the Tweedy Brown overall was 20% compounded rate gain. So that was way above. Buffett partnership. Buffett partnership, table 3. So overall results from the Dow, the partnership results, and the limited partnership. So he just compares it to the Dow. 1957, the Dow lost 8.4%, whereas the partnership gained 10.4%. Limited partners gained 9.3%. Holy cow. The interesting thing about the table for Buffett is that they never lost. Ever. They never lost. The Dow was down 5 years, and the partnership and the limited partners always had a gain, and it averaged like 20 to 30% gain. Holy cow, right? That's huge. That's gigantic. On a cumulative or compounded basis, the results are the overall from the Dow is 152.6 with an annual compounded rate of 7.4. The partnership was 2,794.9 with an annual compounded rate of 29.5. And limited partners results was 1,502.7 with an annual compounded rate of 23.8%. Jeez. That's why Buffett is so famous. Holy cow, he never lost money any year. That's amazing. Sequoia Fund. I just remember from the movie, because I remember watching the movie and we were like, what is he doing? And then we finally found out he's on the Sequoia Fund, the guy who first shorted the mortgage market during the housing crisis. He worked for the Sequoia Fund. After the housing crisis, he quit, but this is interesting. Okay, so the Sequoia Fund. Oh, and I'm running out of time on Instagram, so you can watch the replays on YouTube. You can go to my blog, yesfinanciallyfree.com, okay? Yesfinanciallyfree.com to check out replays of everything and get on the email list, okay? That's in my profile on Instagram. Okay, Sequoia Fund. Basically, their gross investment return of the Sequoia Fund was 18.2%, whereas the S&P was 10%. Let's look at Charles Munger. So I guess he managed the Massachusetts Investment Trusts and the investor stock. I don't know. Limited partners. It's a little confusing here. I guess it's his overall partnership and limited partners must be. And these other ones, he's just comparing to these other ones, the Massachusetts Investment Trust. So just so you guys can see, that's the Sequoia Fund. And then Charles Munger. This is Charles Munger. Right there, Charles Munger. Okay. So compound results. Basically, they had negative compound results in 1962 for all the funds, but Charles Munger did 30.1% in the overall partnership and 20.1% limited partners. So he did way better. Wherever every other one was negative, he did highly positive. And it goes by year. And this is the end of the Charles Munger table. It goes on another page right there. You can see that. Okay. So basically, in conclusion, the average annual compounded rate for Charles Munger was 19.8 for the overall partnership and 13.7 for the limited partners, whereas the Dow was only 5%, Tricontinental is 4.6. Lehman was only 5.5. Investor stock was 2.8. Massachusetts Investors Trust was 3.8. So there you have it. Charles Munger did way better. Pacific Partners, table 6. Pacific Partners, Inc. Right there. Okay. All right, so compared to the S&P, the limited overall partnership, the S&P for the he started in 1965, he goes to 1983. So Standard & Poor's 19-year compounded gain was 316.4%. Limited Partners 19-year compounded gain was 5,530.2%. Holy freaking cow. The overall partnership 19-year compounded result was 22,200%. Holy smokes. The Standard & Poor's annual compounded rate was 7.8%. Limited Partners 19-year annual compounded rate is 23.6%. Overall partnerships 19-year annual compounded rate was 32.9%. That is huge, huge. Pearl Meter Investments. Pearl Meter Investments right there. Okay. So PLI overall and limited partner. Total partnership percentage gain from 1965 to 1983 was 4,272.2%. The limited partners percentage gain from 1965 to 1983 was 2,309.5%. The annual compound rate of gain overall partnership was 23%. The annual compound rate of gain for limited partners was 19%. The Dow Jones Industrial Averages was approximately 882. Dow Jones Industrial Average in 1983 was 1,225, and the approximate gain of the Dow Jones Industrial Average was 7%, including the dividends. The Washington Post Company Master Trust. That's right here. Okay. So there's 3 managers, and he puts in the bonds and cash, the common stock, and all investments. And he puts in the return and the rank. So for all investments, manager A was ranked 2. He had a 4.1% return in that quarter. But the year-ended return was 22.5%. And his rank was 10. In 2 years, his rank was 40 with a 20.6% return. And in 3 years ending, he had an 18% return, ranked 10. 5 years ending, he had a 20.2% return, and he was ranked 3. Manager B had a rank of 4. Basically, he's talking about his rank. Manager B was ranked 1 for a long time, actually. He did really well. Manager C was also ranked 1 a couple times, and the Master Trust, all managers ranked 1 all the time. All the managers, their returns were in the 20s, high 20s, well, 20%, not high 20s. 28.1% for that year, but in 3 years, 24.3% return, and in 5 years, 21.8% return. That's pretty high. For common stock, they had returns as high as 41.2%. For bonds, their returns was between 9.7 to 21. Bonds and cash equivalents return was 10.2 to 17.8%. And then he has FMC Corporation Pension Fund. And let's see. In 9 years, the return has been 17.1% for the FMC bonds and equities combined. Becker Large Plan median was 12.6%. S&P was only 15.6%. I don't know what Becker Large Plan means. FMC did better anyway. Looks like the FMC did 17.1, 18.5% from equities only, which is higher than the S&P and the Becker Large Plan. I don't know what Becker Large Plan is. Okay. So that is the end of the Walter Dodds portion. I don't know. I guess I'll read the next appendix and finish it off. And then we'll be done. Yes, I will. I will finish that. Okay. Number 2, important rules concerning taxability of investment income and security transactions in 1972. Okay, so this is tax stuff. But rule number 1, interest and dividends. Interest and dividends are taxable as ordinary income, except A, income received from state, municipal, and similar obligations which are free from federal tax, but may be subject to state tax. B, dividends representing a return of capital. And C, certain dividends paid by investment companies. And D, the first $100 of ordinary domestic corporate dividends. Rule number 2, capital gains and losses. Short-term capital gains and losses are merged to obtain net short-term capital gain or loss. Long-term capital gains and losses are merged to obtain a net long-term capital gain or loss. If the net short-term capital gain exceeds the net long-term capital gain, 100% of such excess should be included in income. The maximum tax thereon is 25% up to $50,000 of such gains and 35% on the balance. Now, these tax laws are different now probably, but a net capital loss, the amount exceeding capital gains, is deductible from ordinary income to a maximum of $1,000 in the current year and in each of the next 5 years. That is pretty much the same. Alternatively, unused losses may be applied at any time to offset capital gains. Carryovers of losses taken before 1970 are treated more liberally than later losses. Yeah. Losses suck. Like, they don't have very little consequence on your taxes. Note, concerning regulated investment companies. Most investment companies take advantage of special provisions of the tax law which enable them to be taxed substantially as partnerships. Thus, if they make long-term security profits, they can distribute these as capital gain dividends, which are reported by their stockholders in the same way as long-term gains. These carry a lower tax rate than ordinary dividends. Alternatively, such a company may elect to pay 25% tax for the account of its stockholders and then retain the balance of the capital gains without distributing them as capital gain dividends. 3. The new speculation in common stocks. What I shall have to say will reflect the spending of many years in Wall Street and their attendant varieties of experience. This has included the recurrent advent of new conditions or a new atmosphere, which challenge the value of experience itself. And this is an address of Benjamin Graham before the annual convention of the National Federation of Financial Analyst Societies in May of 1958. It is true that one of the elements that distinguish economies, finance, and security analysis from other practical disciplines is the uncertain validity of past phenomena as a guide to the present and future. Yet, we have no right to reject the lessons of the past until we have at least studied and understood them. My address today is an effort toward such understanding in a limited field, in particular, an endeavor to point out some contrasting relationships between the present and the past in our underlying attitudes toward investment and speculation in common stocks. Let me start with a summary of my thesis. In the past, the speculative elements of a common stock resided almost exclusively in the company itself. They were due to uncertainties or fluctuating elements, or downright weaknesses in the industry, or the corporation's individual setup. These elements of speculation still exist, of course, but it may be said that they have been sensibly diminished by a number of long-term developments to which I shall refer. But in revenge, a new and major element of speculation has been introduced into the common stock arena from outside the companies. It comes from the attitude and viewpoint of the stock buying public and their advisors, chiefly us security analysts. This attitude may be described in a phrase: primary emphasis upon future expectations. Nothing will appear more logical and natural to this audience than the idea that a common stock should be valued and priced primarily on the basis of the company's expected future performance. Yet, the simple appearing concept carries with it a number of paradoxes and pitfalls. For one thing, it obliterates a good part of the older, well-established distinctions between investment and speculation. The dictionary says that speculate comes from the Latin specula, a lookout. Thus, it was the spectator who looked out and saw future developments coming before other people did. But today, if the investor is shrewd or well-advised, he too must have his lookout on the future, or rather, he mounts into a common lookout where he rubs elbows with the speculator. Secondly, we find that for the most part, companies with the best investment characteristics, i.e. the best credit rating, are the ones which are likely to attract the largest speculative interest in their common stock, since everyone assumes they are guaranteed a brilliant future. Thirdly, the concept of future prospects, and particularly of continued growth in the future, invites the application of formulas out of higher mathematics to establish the present value of the favored issues. But the combination of precise formulas with highly imprecise assumptions can be used to establish or rather to justify practically any value one wishes, however high, for a really outstanding issue. But paradoxically, that very fact on close examination will be seen to imply that no one value or reasonably narrow range of values can be counted on to establish and maintain itself for a given growth company. Hence, at times, although the market may conceivably value the growth component at a strikingly low figure. Returning to my distinction between the older and newer speculative elements in common stock, we might characterize them by two outlandish but convenient words: endogenous and exogenous. Let me illustrate briefly the old-time speculative common stock, as distinguished from an investment stock, by some data relating to American Can and Pennsylvania Railroad in 1911 to 1913. Actually, I'm not going to finish this. I'm going to stop here. So maybe I'll read this appendix tomorrow because I've been reading for a while. So thank you for Postscript and Appendixes of The Intelligent Investor by Benjamin Graham, The Superinvestors of Graham-and-Doddsville by Warren E. Buffett. My name is May Duldow. This is YesFinanciallyFree.com. The YouTube channel is Creative Abundance Now. If you're watching this on my blog, YesFinanciallyFree.com, go to the right side, put in your first name and email address, get on the email list. All my recordings are here too, and I will see you again tomorrow to finish up the book. Aloha, take care, and happy investing.